In today's episode, we're going to talk about the transition to a 24-hour stock market and the implications this is going to have for active traders like myself and perhaps you as well. My name is Ross Cameron. I'm a full-time trader and I focus on trading volatility. I learned early on that you don't make money buying a stock at $5 and selling it at $5. I make money when I can buy something at $5 and it screams up to $6, $7, $8, $9, $10 a share. But what's going to cause the stock to go up 100% in, let's say, less than an hour? Something special has to be happening. Now, typically, that's going to come in the form of the company itself putting out breaking news, and that's the catalyst. That's the spark that ignites this volatility. And what we've learned is that there's a window of time each day where if a company is going to put out news, it'll probably be putting out news during that window. So what does a 24-hour market mean for that strategy? Are we going to start seeing companies putting out headlines at 1:30 in the morning or 8 o'clock, 9 o'clock, 10 o'clock at night? This is something a lot of traders have been asking. And what's kind of brought all of this to the surface is the recent proposal from the New York Stock Exchange to extend daily trading to 22 hours a day. But you know what? This isn't new. Robinhood has already been offering 24-hour trading for over a year. And why the New York Stock Exchange is doing 22 hours instead of 24 hours, I have no idea. They propose the market opens at 1:30 a.m. Eastern Standard Time and closes at 11:30 p.m. I don't know who came up with these hours. I really think they should have just gone for the full 24-hour day that Robinhood, Charles Schwab, and so many brokers are already offering. But let's talk here about what this 24-hour market means for active traders. We're going to jump into a slide deck here because we've got a lot to cover. So what's really interesting to me is that all of this began with Robinhood. Robinhood, they came onto the scene first with commission-free trading. And if you recall, in 2019, suddenly the final domino fell and all of the brokers went to commission-free trading. It happened within a week. All of a sudden, E-Trade, Fidelity, Charles Schwab, Interactive Brokers, boom, 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 boom. They're all doing commission-free trading. So what finally happened was we just reached this kind of balanced tipping point where the brokers realized if we don't offer commission-free trading, we're gonna lose business to other brokers. The same thing is happening with the 24-hour markets. So in May of 2023, Robinhood came out with 24-hour trading, but only on a select group of stocks and ETFs. So it's not on every stock in the market. In fact, it's only on a small handful of stocks, and it's really the stocks that typically trade with the most volume, like Apple, Nvidia, the S&P 500 as an exchange. So unfortunately, or as an ETF. So unfortunately, it wasn't widespread enough that a trader like myself was really able to profit or trade the 24-hour markets. And there's a couple other limitations that held us back, and I'll share those with you in a moment. So the way it works is for Robinhood to be able to execute orders when the regular market is closed, they do that by contracting with a firm that runs an alternative trading system. It's called an ATS for short, and it's essentially like an exchange. It acts like an exchange, but it's not officially an exchange. To become an exchange, there are certain things that a firm would have to do. And it's quite a battle in terms from a regulatory perspective to actually become a stock exchange. But becoming an alternative trading system, the barrier to entry is much lower. And all the way back to the 1990s, firms were creating alternative trading systems. And the reason they did this was because let's say there's a trading desk at a firm. Let's say it's a big bank and they've got 100 traders on the floor and one trader's buying and one trader's selling. Well, typically those orders would both go to the exchange, right? They'd go to the New York Stock Exchange or they'd go to NASDAQ. But what if there's a buyer and a seller that are together on the same trading floor? Could you just connect them without going to the exchange? Maybe you could. And what's the incentive to do that? Well, every time an order is filled on the lit market of New York Stock Exchange or NASDAQ, the exchanges make money on that. So the brokers pay a fee. So they realize, well, why don't we just start connecting our orders internally if possible? And if we can't, then we'll send them out. And in fact, that's exactly what happens in the payment for order flow structure that so many brokers that offer commission-free trading currently use. The orders are filled internally through an ATS offered by an institutional wholesaler, And if they can't match the order internally, only then does the order go out to the main market. And so the way this is working with Robinhood is the extended hours orders are being executed by a firm called Blue Ocean, and they run an alternative trading system. So this ATS is very similar to an exchange. It matches buyers and sellers, but unlike a licensed stock exchange, the ATS does operate under a different set of rules. For instance, one of the rules is that an ATS is not required to publish an order book. And that's why the first ATSs were actually called dark pools. If you've heard the expression dark pools, the reason it's a dark pool is because there's no order book. There's no level 2. But what's interesting here is that all dark pools are ATSs, but not all ATSs are dark pools. And so Blue Ocean, for instance, does publish a level 2 order book. So they don't have to, but they do. So you can see the buyers and you can see the sellers. So that's a choice that the ATS can make. Now, so that's the way these orders are actually being executed, but Blue Ocean has a couple of limitations. And one of the limitations is that they will only execute orders in a range of 20% above or below the daily reference point of a stock. So if you recall, in June of 2024, when Roaring Kitty came out and said he's back in GameStop, that was on a Sunday night. And so what happened? Sunday, 8 p.m., boom, GameStop squeezes up in the after hours 24-hour markets. It went straight up until it hit the up 20% threshold, and then trading was halted. All right, so then that was it. Now, currently, stock exchanges don't employ these types of restrictions during extended hours. So the current market hours right now for all exchanges is 4 a.m. to 9:30 a.m. That's pre-market. So this is pre-market. And then until 4 p.m. So this is regular trading hours right here. And then this is after hours until 8 p.m. So this is our current trading cycle. Now from 9:30 to 4 p.m. we have market orders, we have stop orders, and we have limit up, limit down halts. And of course we have options trading. But between 4 a.m. and 9:30 a.m., you don't have any of this. And between 4 p.m. and 8 p.m., you don't have any of this. So what we typically see on most stocks, if we pull up the chart on, I'll just grab a stock today. So today I'm sitting here up about $14,400. I traded a number of different stocks. This is one that I traded, and you could see the volume pre-market, nothing. Regular trading hours, a lot. Extended hours right now, after hours, very minimal. And this is what we're typically going to see from most companies. Now, if we look at the S&P 500, obviously the S&P 500 has almost no volume during the pre-market. Then 9:30, boom, volume spikes. And then all of a sudden after hours, it goes dead. This is how it is for most companies. Most traders, even though they can trade before 9:30 a.m., most don't. So isn't that kind of funny? Right now, the market currently opens at 4 a.m. and it closes at 8 p.m. But look at how much volume occurs during those pre-market and then extended hours times. It's a fraction of regular trading hours. So one of the reasons that I don't think 24-hour markets is going to have a significant impact on my strategy is that more or less we already have 24-hour markets, number one. And number two, we already have long extended hours for pretty much every stock from 4 a.m. to 8 p.m. And we still see that trading is concentrated during small windows of that time frame. So ultimately, in order for us to see a big shift in trading and the time of day that we see this volatility, we would need to see companies start putting out those news headlines at 1:32 in the morning, which is certainly possible. And there are a lot of internationally listed companies that are on the US market that may choose to do that because that's when their company is open, but I don't think it's as common. So the expansion from Robinhood to other brokers has happened fairly quickly. Right now, as trading in the stock market is becoming and has become increasingly popular, both in the United States and internationally, more brokers are feeling compelled to offer 24-hour trading. So now Charles Schwab has made a similar announcement. They said this is Robinhood talking about their 24-hour markets. And then Charles Schwab says, here we go. We're going to significantly expand 24-hour trading capabilities to include stocks in the S&P 500, NASDAQ 100, hundreds of additional exchange-traded funds. So they're jumping on the bandwagon too. And this is Blue Ocean Technology here and all the different firms that they work with. And you'll see these are a lot of big clearing firms. I mean, these are big names here that they're working with on this 24-hour trading ATS. So now the exchanges feel like they're missing out. And what's happened over the last several years is more and more volume has moved off the exchanges. So, of course, this is the hours of trading, not 4 a.m. until 8 p.m. And this works for NYSE, NASDAQ, Amex listed stocks. But what we know is that currently, if you have a broker, let's just say like Robinhood, so you've got your account at Robinhood right here, and you want to send an order to the market, that order is first going to go to the ATS, right? The alternative trading system. And typically they'll match your order and give it to you right back there. And your order never actually goes out to NASDAQ, NSDQ. Your order never gets to the actual market. So who loses money? NASDAQ, sad face, with a couple of tears coming down on the side because they're missing out on the payment for order flow. Who's getting it? Citadel, these big institutions here that are executing their orders for Robinhood, for I'll just say Thinkorswim, which is Charles Schwab, but you get the idea. So these orders are getting routed here. Now, something that's a little bit of a challenge is, let's say you want to buy 50,000 shares right here. If you want to buy 50,000 shares and there's not a match for you inside this alternative trading system, well, you have to get your order out to the market. And this creates a little bit more latency in routing your order. As long as you don't mind that latency, commission-free trading is fantastic. But if you want really fast executions, you may want to bypass this entirely and go direct to the market. The only problem is you can't do that with a lot of commission-free trading brokers. You have to go through an institutional broker right here that caters to professional or very active traders and gives them the ability to route directly to these types of markets. The only problem with this type of broker is that you can't route to here. So now, if I'm over here and you're over here, our orders shall never touch because we're completely separate. So we actually are trading during a period where the market has become more segregated than ever before. It used to be that it was one auction where all the trades came together. And then through the creation of these alternative trading systems, the market became more and more siphoned into these small pools of liquidity. So who's missing out on this? Well, the exchanges are missing out, but the exchanges have a very high regulatory standard that they have to meet and adhere, which makes sense. It's an exchange. And so they're not able to move quickly. They're not able to do the things that alternative trading systems have been able to do in the past. One of the reasons dark pools were so popular is because traders said, well, wait a second, when I'm putting out an order to buy 50,000 shares and it goes on NASDAQ, you know what keeps happening? Some idiot, and maybe idiot's not the word that they would use down on the floor, but some jabroni, maybe that's not the word they'd use either, is cutting in front of me. They cut in front of my order. My orders are too big, so I want to send my orders to a dark pool. I want to send my orders to a dark pool where there's no book. That way I can put my 50,000 share buy order out there. And if there's someone that wants to sell 50,000 shares, we'll be matched. And the order will go through on the tape, but there will not be a record of my order sitting there on the bid for someone else to cut in front of. So the broker that I use does allow routing to dark pools. It does allow routing direct to the market. And it is a broker that still charges a commission for every single one of those trades. Now, if I was only trading with 1,000 or 2,000 shares, it wouldn't matter. But when you trade with bigger size, you're going to find a limitation with these brokers. So nonetheless, we now have this decision by the New York Stock Exchange to try to jump on board and get into 22-hour-a-day trading. They'll eventually probably do 24 hours a day. Now, NYSE, for instance, only offers a small percentage of all the stocks listed on the market. Most of the stocks I trade on any given day are actually NASDAQ-listed stocks. So NASDAQ is the one that really needs to jump on board in order for us to maybe potentially see more volatility in the extended hours. So one thing that you may wonder about is, pricing discrepancies. In the world of cryptocurrency, it's often the case that the same currency, like Bitcoin, will actually be trading at two different prices at the same time on two different exchanges. So in the world of the stock market, we have what's called Reg NMS and the National Best Bid or Best Offer, NBBO, not to be confused with VRBO. It's completely different. There's no rentals involved here. The NBBO is the requirement for brokers to execute your order at the best bid or best offer, even if that means rerouting your order from this ATS to NASDAQ. So what's not allowed for an ATS, you cannot, if the best offer is 250, and you're trying to sell stock, right? Or sorry, you're trying to buy stock. You cannot get filled here at 255 or 260 while the current NBBO is 250. So an ATS cannot fill you at a higher price than current market because of Reg NMS and the NBBO. So as a result, we will not see a pricing discrepancy where, let's say, Blue Ocean is showing one price of a stock, but the New York Stock Exchange is showing a different price. We will see that the prices are matched because of these regulations. However, some implications for active traders. So myself, I focus on trading the news cycles, and I'm primarily trading the morning news cycle. We know that most companies put out news between 7 a.m. and 9:30 or between 4 p.m. and 5 p.m. These companies are making a logical decision to put out news headlines during the times when there are the most active traders watching the market. Now, perhaps companies will be inclined to put out bad news in the middle of the night, hoping traders will forget it. However, I think if all bad news headlines were released at 2 a.m. and all the good headlines came out at 7 a.m., regulators would take issue with this practice. I think that would be a problem. Now, something that I wonder is currently Blue Wave or Blue Ocean. So Blue Ocean, let's see, B-O-T, it's Blue Ocean B-O-T-A-S, boats. So currently the boats ATS, or whatever you want to call it, has this 20% limit up, limit down on the day. Now, the New York Stock Exchange, NYSE, does not have that pre-market or after hours. So if NYSE gets approved for 22-hour per day trading, and they don't have a limit up, limit down at 1:30 or 2 in the morning, then I think they're going to have to also take away this 20% restriction. That's my guess. Now, I could be wrong, but that's my guess. But currently, it's a limiting factor because I want to trade a stock that has a potential to go up 50% or 100%. If I'm limited at 20%, that's not going to work. So again, this is subject to change. Not that any of these changes happen quickly, because they don't. But currently, there's a limit to large moves during extended hours. There is less liquidity. And the problem with that is, let's say you had someone like Warren Buffett, who's got, $350 billion of cash. Let's say at 1:30 in the morning, he took a couple $1 billion and started buying the S&P 500. There's not going to be a lot of sellers at that time of day. There's no stop orders. The good till cancel orders are not on the market. So there'd be the potential that a really large order could move the entire market substantially. Now, that can still happen right now from 4 a.m. to 9:30 a.m. and from 4 p.m. to 8 p.m., but it doesn't happen. So, I suppose it happens sometimes, but it doesn't really happen. So this 20% range, my guess is it's going to go away eventually. Once the exchanges come on board, they're going to kind of set the rules, because it wouldn't be allowed for one broker to say we're no longer offering trading when other brokers will continue out trading. Everyone will just switch to that broker. But there will continue to be no stop orders, no market orders, no good till cancel orders, and no options trading during these extended hours, because that's currently not the way the market has been set up. So only offering S&P 500 companies or ETFs, that's definitely limiting options. By the time we get to penny stocks and small caps, which would come if the New York Stock Exchange and NASDAQ both got on board, then we get into a bit of a situation of, okay, could we start seeing some news headlines coming out in the middle of the night? And this is what I think could happen. I think we could start seeing that all of a sudden, 1:30 in the morning, there's, a bunch of traders jump on a stock that starts spiking. It hits the high day momentum scanner. It goes from $2 to $3 to $4 to $5. But how many people are really sitting and watching at 1:30 in the morning? Now, maybe we find that there are traders that are in Europe or who are in Asia who want to participate and trade the US market, and they're going to trade during those hours. But what's ultimately going to create sustained and lasting volatility will be the news. So it's going to be the companies that themselves have to decide, I'm not going to put out news during the 7 a.m. to 9:30 window or the 4 p.m. to 5 p.m. window. We're going to start putting out news headlines at 8 o'clock at night or at 9 o'clock or 10 o'clock or whatever the case is, 2 in the morning. And I don't see that being very likely because these companies, they want to put out news not just to create a short-term spike and then the price comes right back down. They want to see their company to continue to surge up on volume, especially small cap companies, because what a lot of these small cap companies are doing is they're putting out news headlines. They often have a shelf registration and they need that high level of volume to support their ability to raise more capital. So they're thinking about this very strategically. It's part of their PR sort of agenda that we've got to put out news headlines at these times of the day when traders are going to see them, and then we'll be able to do this offering and, raise money. So putting out news headlines in the middle of the night, I don't think it's going to be super popular. But again, there's a lot of companies listed on the US market that are Australian. We've got a lot of companies that are from China that are on the US market. So currently, those companies could put out news at 2, 3, 4 in the morning, and trading begins at 4 a.m. And we do sometimes see spikes at 4 a.m. But what typically happens is those spikes get reversed. They don't hold up because there's not enough volume to support it. So what ends up happening, if we jump over on the whiteboard, is all of a sudden at 4 a.m., you'll see a stock start to spike up here, and it goes up quite a bit, but it's going up on very light volume. So the volume may be increasing, but in total, it's light. So by the time you finally see it here, it might be up 40%, but let's just say it's on, 100,000 shares of volume. The volume's relatively light, and you feel like, gosh, it's up so much. How many shares can I really buy of this thing if I want to get in? And suddenly it drops, quite a bit. And that's because often on light volume, you have what? Bigger spreads. The spread is the difference between the bid and the offer. So I'll show you here. I'll just jump back onto the whiteboard first, or I'll jump back onto the screen share here. So let me just show you the level 2 of a couple of different stocks. So this is ADN. This is a stock that today traded 66 million shares of volume. CHSN is a stock that traded 255,000 shares. Look at the spread, 1020 by 1122. This has a really big spread. So if all of a sudden it goes up to 12 or 13, but it's still trading with a 1-point spread, it feels like it's hard to manage risk. So what ends up happening is a lot of these pop up, but they start coming back down. They have big spreads and the move's not sustained. So they kind of make their way up, they come back down. And then once they're all the way back down here, it's like, well, the stock's flat. It's no longer of interest. So in a way, even if the stock had good news, if there's not the traders there to buy that news event, what does the news really mean? This is something very interesting. I noticed one of you guys posted in the comments that you don't read the news thinking about the quality of the news headline for the company. You read the news thinking about what other traders will think about the news. And that's a really good observation because ultimately that is all it's about. What do other people think about this news? If you've got a company that says they're in the news headline, they've got a partnership with Google, that sounds really good. Everyone knows the name Google. So that's probably going to be a headline that causes a big spike in the stock. If you have a headline that, is they've partnered with, I don't know, some no-name company, it's like, what do other people think of that? Maybe they probably won't think as much of it. So there is a huge degree of stocks go up because people like the headline. They go up because they think the stock has the potential to go higher. Sometimes I even think this about the float. I know that I do better trading stocks that have lower floats. But what if, for instance, a stock hit my scanner and by error, the float showed 5 million shares when it was really 50 million shares? So would it then move like a 5 million share float because everyone perceived it to be a 5 million share float? On the one hand, you might think maybe, just maybe it could. But there are some practical factors here, including float rotation, whether the stock is easy to borrow or hard to borrow, the number of shares that are available to trade, whether there's a lot of insiders who are suddenly up 50 or 100% and want to sell. So from a practical standpoint, there does have to be substance. The float has to actually be lower. The news has to actually be decent in order for it to hold up over the long term. But there is a good argument for thinking about the headline of what are other people going to think about this? And unfortunately, when you put out a headline after hours or in the middle of the night, it's going to get ignored. It's going to get missed. So I think that there's another thing here that's interesting, which is that in Forex trading, Forex pairs can trade 24 hours a day, but there are windows where you see heightened volatility. And these windows are a little bit different. This is where you have the overlap between the market hours of these different economies where their currencies are trading. So, let's just say you've got Europe, the euro, you've got the yen, and you've got the US dollar. For instance, you might have this small window here where you're like, okay, this is our tiny little window of overlap. So this is where we're going to focus. So this area here where we've only got one currency, one of those economies is sort of open, and their bond markets are open and their exchanges are open. You're going to have less volume than the areas where they overlap. And I think that that's probably what we're going to see with the 24-hour stock market as well. Even if we become fully integrated with 24-hour markets, I think there will continue to be windows based ultimately on when companies are most likely to put out news, which will be based on when people are most likely to be trading in the markets. And so that's going to be based on certain times when you're going to get US traders, West Coast, East Coast, West Coast traders, European traders, and Asian traders all together for that little window of the day. That's when the magic is going to happen. That's when we're going to see the peak of volatility. So that's my take on this transition to a 24-hour market. I'd love to hear what you think about it. As always, I'll remind you, trading is risky. My results are not typical. I've been doing this for a long time, but if you want to learn more about what it's like to trade, I'd love to have you come check out our program over at Warrior Trading. You could do a 2-week trial, and during that trial, you'd be able to watch me trade every single day. You'd be able to use the software that I'm using, the stock charts, the scanners, the news feed, of course, the chat room and my live broadcast. So check it out. I'll put a link down in the top of the comments. I'll also put it in the description so you can learn more about the strategy I'm trading every single day and becoming part of the Warrior community. Thanks as always for tuning in. I'll see you for the next episode real soon.